central banks are now buying silver, a lot of silver. And to me, that's a game changer because up until recently, people said that the gold silver ratio was this high because silver is only an industrial commodity and that central banks only buy gold. But I think things are changing.
So, Mario, if silver gets to the sort of rather middle of the range area, let's say 50 to 1, what's the price of silver?
50 to 1, that would be about 80 if gold doesn't change, right?
And I think it will. I mean, obviously, the historical number was more like 20 to 1 or even
Or
15 to 1.
The first sign something real is shifting shows up in the physical market, not the charts. Mario, Innecco and Clive Thompson keep coming back to this because people are having trouble getting kilobars. When supply gets patchy at that level, it isn't retail noise. It's steady, determined buying that doesn't care about intraday candles or ETF flows. That alone would make things interesting, but the whisper circulating behind the scenes is even bigger. Central banks may be dipping into silver. For decades, the pitch was simple. Silver stayed cheap because it was an industrial metal, not a monetary one. If official buyers start accumulating, that story breaks. And once it breaks, the market has to reprice the entire monetary role of silver, not just its use in solar panels and electronics. Then they walk through the ratios. If silver only drifts back to a middle-of-the-road gold-silver ratio of 50 to 1, you're already staring at something near $80 with gold unchanged. But the long arc of history is tighter. Ratios of 20 to 1, 15 to 1, even 12 to 1 weren't rare. Today's 70s and 80s look wildly stretched if monetary demand returns in any meaningful way. Thompson puts size into perspective. The S&P hovers around 55 trillion on a log scale. The entire silver market barely reaches 2 to 3 trillion. Silver miners together are roughly 54 billion. About the size of one large tech stock, not even a leader. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Oliver was telling me that it's difficult getting the kilobars right now. So yeah, physical silver demand is very strong, and I'm still hearing, Clive, that central banks are now buying silver, a lot of silver, and to me that's a game changer because up until recently people said that the gold-silver ratio was this high because silver is only an industrial commodity and that central banks only buy gold. But I think things are changing.
So, Mario, if silver gets to the sort of rather middle of the range area, let's say 50 to 1, what's the price of silver?
50 to 1, that would be about 80 if gold doesn't change,
Hmm.
right?
And I think it will. I mean, obviously, the historical number was more like 20 to 1 or even
Or
15 to 1.
was, yeah, historical is like even 12. I think in Roman times it's 12 to 1. Yeah, 12 to, and then, since the Middle Ages, I think it was 15 to 16 to 1. And one chart I wanted to show, Clive, is the S&P versus sorry, silver versus the S&P ratio. And I've got it as far back as the early 1900s. And you can see that it's in a falling wedge formation. I know it's a 100-year falling wedge, but we can see how undervalued silver still is up until, I mean, up until 1991. The gold silver, silver had never traded below this level here, 0.013 versus the S&P. And we're still below that level. I mean, there's a lot of potential. I calculated if we go back to the old high not on a closing basis, this is a closing basis chart, but if we go, I think the high on intraday is like 40 something, 45.45. It would mean silver going up almost 60 times in relationship to the S&P. And I think we're breaking out here, Clive. I know gold and silver have kind of been consolidated since mid-October, but they needed a break, some kind of pause. But it still looks really good. So I think we need to keep an eye on this chart, and it could. I think I have a feeling it's going to take a lot less time for it to spike than how much time it's taken overall, this falling wedge. So I think this is something important to keep an eye on.
I'm just looking, I can't show you, but I'm looking for a chart of what the value of the silver market is
Yeah,
versus the stock market. I know I had that on my screen a bit earlier today. I'll tell you when I find it.
yeah. And the other thing I was looking at, which is interesting, that year to date, silver is up 73%, gold is up 55, and Bitcoin at 86,000 is down about 7%.
What we're looking at here is the total size of the S&P 500. Now, this is a logarithmic scale. I want to stress it's logarithmic. So the lines are not, the bars are not in scale and percentage because it's on a log scale. But you see the S&P 500 is 55 trillion.
Yeah,
The silver market is 2 trillion
yeah,
ish, to call it 3 trillion if you want. Only a tiny amount of stocks deciding to reallocate to precious metals, silver in particular, would have a very dramatic effect on the silver price. And of course, when you look down at the gold mining sector, which is less than 1 trillion, less than a quarter of less than 1/5 of the value of Nvidia, and the silver mining sector at 54 billion, a tiny, which is really a tiny, tiny fraction of any of the tech stocks. So there's a lot of, what I'm trying to say is here, if the wind goes out of the sails of the AI sector, which is driven by the four largest companies in America, probably, and people start to look for other things, you don't need a lot of those other things to head in the direction of precious metals, and precious metals will fly.
Here's the thing Francis Hunt and Mario Innecco keep circling back to. The real bottleneck isn't charts or sentiment, it's supply. We've brushed up against genuine physical stress in the silver market more than once, and every time the system survived because someone patched the hole with a quick injection of metal. Hunt doesn't think the next round will be that easy. Silver production is stubborn. Most of it comes from mines focused on copper, zinc, or gold, so even a big price spike won't magically create new supply. These miners won't redesign their entire operation just to chase a side metal. Geology doesn't care what the spot price is. Economics doesn't bend that fast. That's why a real demand shock can't be met with a wave of fresh silver the way people assume. The pipeline is fixed, slow, and already tight. Innecco's angle is the price action. He was looking for one last pullback around the $50 region. Silver stretched to 54, slipped to 47, and that was the flush he'd been waiting for. Now the pattern is tightening again. The market tried to smack silver lower on Friday and couldn't keep it there. Buyers stepped in fast, lifted it back up, and showed there's still strong demand under the surface. Let's get back to the interview.
There's not much physical silver left in London. And of course, you can always get the silver, but it depends on the price. And there's also backwardation. The spot price is still higher than the December price. So, yeah, and I've been hearing from good sources that central banks are buying billions of dollars worth of physical silver, even directly from the mines, the miners, which tells me that they can't find it anywhere else. So they are going straight to the source.
Yes, so there's better people for tracking the inventory numbers, but my overall suspicion is that we've had a number of near-thing runs that have been papered over, and the eventual collapse is pretty much baked in on a supply situation. So, and this is technically where we've been. I've got my whole community on red alert. Mario, you might remember, just dealing with this question, Ref Silver specifically, that we had a moment where I said there could be one more rejection at the 50 range. We talked about once, twice, three times a lady. I use these metaphors so that people remember you say something. It's easier to remember that. It was a line out of a Lionel Richie song. Not that I was a fan, but anyway. we went up to 54 and we pulled back down to 47. And I don't think you have much of a big dip, but I was expecting some form of a technical rejection. At the time, it was moving very strongly and you thought it would continue, and that was our only point of difference. Now we've had that rejection that went with the gold, which is why we also met our platinum target. So we're actually looking to exploit the failure of the fiat debt system by trading as well as investing. And you need to be careful when you trade. And it's not necessarily for everyone, but we have real method with regards to doing that. And it's our overall opinion, and it's something I don't stop like a flea in the ear of my community saying, you are not missing the silver move. You are not missing the silver move. This wick could literally be that it doesn't need to be a big rejection because of the fundamentals of the supply being so rattled. It's not something you paper over. That's another point, just by the way, on supply. So much of silver production is incidental secondary product. You don't have pure mines that you can just say, hey, can you open up that other shaft that you've already dug and all of that and just start pumping it out now that prices are better? No, you don't. You're relying on gold, zinc, copper miners who actually stumble on silver where there's a reasonable percentage of it. And because they've already expended all the energy in digging the ground for the primary copper, gold, or zinc, you get a disproportionately low cost attachment to the secondary silver that is attached. And it's part of their revenue as a copper miner. And if you're not stumbling into secondary product, it's not going to happen. And it's very difficult to forecast that. If you're digging a hole in the ground because of copper content, for which anything else you find is secondary. So that's a supply matter also to add on to the deficit in the LBMA. But this third run here, we've had on the smaller timeframes, we've had that rejection from 54 down to 47. And when we look at this on a smaller time frame, it's our take. You're going to the 90s. You'll probably have a pause just below the 3 digits and then 330. And we've done that draw before. And the key reason I bring this chart that many people have seen before is that I actually think this is that third rejection, and the lady is coming very shortly. So I've dropped from the big macro view time frame just to bring it to the here and now. And I'll highlight that Fridays are often Mr. Slammy days, and the day traded quite hard to the downside and then subsequently wasn't being held all the way to the downside and retreated most of the way back up. We'll have a Sunday open, of course, coming not too far off from now. And I would suggest you're not very far away from this structure. And that's what my community guys are having me be a real bee in their bonnet about, because the breaking of this continuation structure is your lady that I was talking about when you said we're through and we're off to the races. I said, we're going to get a little nudge back one more time. That's the technical aspect. And now I'm where you were last time when we were at 54. You don't want to miss this. So that's the silver.
Something's taking shape in the precious metal space that doesn't feel like another routine swing. You can sense it in the places that usually stay quiet: the tightening availability of kilobars, the odd behavior in spot markets, the way buyers keep stepping in even when prices briefly dip. When physical supply starts wobbling before price does, that's the market's way of hinting that the pressure is real, not narrative-driven. Add the possibility of official interest in silver, and the old assumptions begin to crumble. The separation between an industrial metal and a monetary metal starts to look like an outdated script rather than a reliable framework. Pair that with a tiny market cap, slow-moving supply pipelines, byproduct-dominated mining, and suddenly even modest capital rotation becomes a seismic force. The recent attempt to drag prices lower didn't stick, and that failed breakdown matters. It tells you buyers aren't waiting for perfect entries anymore. They're accumulating on stress, not momentum. All of this creates an environment where the next leg isn't dictated by chart patterns alone but by structural constraints meeting renewed monetary interest. The setup isn't about hype, it's about scale. A market this small doesn't need a flood of money. A trickle can reshape the landscape, and the early signs point to that trickle already starting its move. If physical shortages keep tightening while capital keeps leaking out of overcrowded sectors, How long before silver's role gets repriced not as an industrial input, but as a monetary asset waking up after decades of neglect? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.